Hey everyone, welcome back to the Deep Dive. We'd like to just get right into it here. Our listeners are here to learn, and we're here to teach.
That's right. We respect your time. So today, we're diving into something that's been generating a lot of buzz lately: real-world asset tokenization.
RWA tokenization. We hear it everywhere, but what does it actually mean? And more importantly, what does it mean for investors?
Well, to break it down simply, it's about taking something tangible, real estate, art, even a company's inventory, and representing it as a digital token on a blockchain.
Okay, that makes sense. But we've got a whole stack of research here, and it seems like there's more to it than just that.
Yeah, there are actually a couple of different approaches, and it's important to understand the distinction.
Lay it on me.
So the first way is kind of like a derivative. You're creating a token that mirrors the value of the asset.
Got it. So the token's price goes up and down with the asset's value, but you don't actually own the asset itself.
Exactly. The second approach is where things get really interesting. This is where the token actually represents ownership of the asset.
So instead of a paper deed for a house or a stock certificate, you have this token on the blockchain.
Precisely. That token is your proof of ownership. It's a digital title.
Now that's a game changer. But let's rewind a bit. Before we even get to creating these tokens, what are the crucial steps involved in preparing an asset for tokenization?
It all starts with choosing the right asset. I mean, you wouldn't want to tokenize something with a messy ownership history or something that's just not suitable for this whole digital format.
Right, that makes sense.
Yeah.
You want something with clear ownership and a good market potential.
Exactly. And once you've got your asset, you absolutely have to do your due diligence. You need to verify the ownership, make sure there aren't any hidden liens or claims on it. It's like tracing the history of a valuable antique, but for legal purposes.
So like a super thorough background check for the asset.
Precisely. Then you need to figure out the asset's fair market value, essential for pricing those tokens.
Okay, so how much is this thing actually worth?
Right. And then you need to think about liquidity. How easy is it to buy or sell this asset without impacting its price? Like, government bonds are pretty liquid, but say a rare piece of art, not so much.
Makes sense. It's a lot easier to sell off shares of Apple stock than it is to find a buyer for a one-of-a-kind Picasso. What about the legal and regulatory side of things at this early stage?
That's a big one. Before you even think about tokenizing, you need a solid legal evaluation. You've got to consider things like SEC and CFTC regulations, how this all fits in with existing property recording systems, maybe even entity registrations. The legal landscape is constantly changing, especially in crypto, so it's really important to get expert advice here.
It's like making sure all your legal ducks are in a row before you even start the process.
Exactly. And then comes a big decision. Choosing the right blockchain. Think of it like building a house. You need the right foundation. Different blockchains have different strengths. Scalability, cost, how widely they're used, how easy they are to connect to other blockchains.
And like any foundation, it needs to be strong and built for what you're putting on top of it.
Absolutely. Next, you need to decide exactly what your token is going to look like, what it represents. Will it be an ERC20 token, which is usually for things that are all the same, like currency, or an ERC721 for unique items? You'll need to define the rights that come with owning the token, things like voting rights or dividends. How many tokens will there be? When will they be released?
So really defining the DNA of your token.
Exactly. Then think about your target audience. Are you going after accredited investors? Where are your buyers located? Do they have any trading restrictions? And you'll need to figure out how you're going to handle KYC and AML requirements for all your token holders.
So navigating who can buy these tokens and making sure you comply with all the regulations around that. What about after the tokens are issued? What kind of ongoing stuff needs to be taken care of?
Well, there's ongoing legal compliance. Someone needs to make sure you're staying up to date with all the rules and regulations, and this is especially crucial for real-world assets. You need to have a plan for managing the physical asset itself. Who's responsible for storage, maintenance, insurance? If it's a building, someone's got to collect rent and deal with repairs, right?
Right. Just because the ownership is digital doesn't mean the real-world responsibilities disappear.
Exactly. That's a crucial point. Now, let's dip our toes into some of the technical details. You'll often hear about metadata and enumeration when it comes to these tokens.
Metadata and enumeration, those sound pretty technical. Give me the SparkNotes version.
Okay, so metadata is like a digital label for the token. It contains specific information about the asset, maybe its history, details, even images, all accessible through a unique web address linked to the token, like a digital certificate of authenticity. Enumeration basically lets you list all the tokens owned by a specific address or managed by a smart contract. It's useful for tracking and managing collections of these tokenized assets.
Okay, so metadata is like a digital fingerprint for each token.
Yeah, you got it. And enumeration is like a digital inventory system for tracking these tokens.
I'm starting to see the bigger picture here. So what does this mean for someone who's actually holding these tokens?
Well, with metadata, you can easily verify the specifics of the asset your token represents. Imagine you're buying tokenized art, for example.
Mm-hmm.
The metadata can link directly to high-resolution images and tell you all about the piece's history and ownership. Enumeration just makes it easier to manage a whole portfolio of tokenized assets.
Right, it's like having all the important information at your fingertips.
Exactly. And all of this is made possible through smart contracts, which are essentially self-executing agreements on the blockchain. They define the rules for how tokens are created and transferred. It's pretty fascinating how lines of code can manage all of this complex stuff.
It's like the code is the law.
Yeah, in a way. Now, we also dove deep into a white paper that specifically talked about tokenizing global debt markets.
Oh yeah, that one was really interesting. I think it really opened my eyes to how much potential there is in this space.
Yeah, it argues that blockchain could completely revolutionize the world of fixed income. Things like bonds and loans. It could make everything more efficient, transparent, and way more liquid.
And it sounds like tokenization is at the heart of this transformation.
It is. The paper talks about representing those underlying debt instruments as digital tokens on a blockchain. Imagine all the data about a bond, the terms, the regulatory approvals, performance data, all recorded permanently on a distributed ledger.
An immutable record, huh?
Yep, they call it an event series. So the token becomes like a key, giving you access to that whole history.
So it's not just trading a digital representation of debt, but having a transparent and verifiable record of everything that happened with that debt.
Right, and that's what Inveniam is trying to do with their platform.
Yeah, that was cool. I liked the 7 considerations they outlined in the white paper.
Right. One of their key principles is law is served by code, meaning that the smart contract code enforces the terms of the legal agreement, but doesn't replace it.
So the technology is facilitating the agreement, but the underlying legal framework is still there.
Exactly. They also emphasize the importance of having that complete event series we talked about and stress that the system needs to be user-friendly for everyone involved, not just tech wizards.
That's crucial for adoption.
Totally. And integration is another key factor. The system has to work alongside existing financial infrastructure, not just replace it overnight. They also mentioned the role of things like machine learning in analyzing all this data and creating a direct, auditable link between the token and the actual deal documentation.
It sounds like they're building a really robust system. One of the things that really struck me from that paper was the idea that tokenization could blur the lines between public and private markets.
Absolutely. It could make private debt, which is traditionally less liquid, much more accessible and easier to trade, potentially closing the gap between public and private markets.
That could be huge for investors looking for alternative investment opportunities.
Right. And the white paper had this great phrase, calling a token an intellectual cargo vehicle.
That's such a vivid image.
Right. It perfectly captures the idea that the token is carrying so much more than just value. It's holding all the history, the legal documents, all the crucial information about that security.
It's like the entire digital history of the asset is embedded right in the token.
Sure.
Okay, let's zoom out a bit. We've seen some of the benefits in specific areas, but what about the wider benefits of tokenization across different asset classes?
Well, from an investor's perspective, one of the most exciting things is the potential for greater access to investments. Imagine being able to buy a fraction of a high-value property or a piece of a famous artwork. It opens up possibilities that were just not there before.
It's like democratizing investment opportunities.
Exactly. And then there's the whole automation aspect through smart contracts. Imagine automating things like cash flow distributions, managing collateral, even aspects of risk management. All those manual processes can be streamlined.
So less paperwork, fewer middlemen, faster transactions.
Exactly. And with that comes lower transaction costs. Issuing tokenized securities could be way cheaper than traditional IPOs, for example. Plus, the fees for trading these assets on secondary markets could be significantly lower.
All of that makes investing more efficient and potentially more profitable for investors.
Absolutely. And then there's the liquidity factor. Creating functional secondary markets for assets that were previously difficult to trade can unlock a ton of value.
Because if you can't easily sell something, it's not really worth as much.
Right. It's called the illiquidity tax. Tokenization has the potential to reduce or even eliminate that. And on top of all that, you have the reduced counterparty risk because you're relying less on intermediaries. You also get faster settlement times, maybe even instant in some cases, and markets that operate 24/7.
It's like the traditional barriers of time and geography are dissolving in this new world.
They really are. And let's not forget the increased transparency offered by blockchain. All the transactions, the ownership history, it's all right there on the ledger. This not only benefits regulators, but also builds trust in the market. Plus, tokenization could potentially open up investments to a wider pool of investors, including retail investors, although that's still dependent on regulations.
It sounds almost too good to be true. But we've got to be realistic, right? There have to be some challenges.
There definitely are. It's not all sunshine and roses. One of the biggest hurdles is proving ownership. How do you definitively link a digital token on a blockchain to a real world asset, like a piece of real estate or a valuable artwork? You need to be able to verify that the token holder actually owns the asset in a way that's legally recognized.
Right. The token is just a representation, but how do you guarantee that it accurately reflects ownership in the real world?
Exactly. And this leads to another challenge. In many legal systems, owning a token isn't automatically the same as owning the underlying asset. It's like the token might be evidence of ownership, but it's not necessarily the title itself.
So the legal framework needs to catch up with this new technology. What about knowing who owns these tokens? That's got to be important for regulatory purposes.
Absolutely. We have all these KYC and AML regulations designed to prevent money laundering and other financial crimes. But the crypto world often values anonymity, so finding the right balance can be tricky.
It's about finding a way to satisfy both the need for transparency and the desire for privacy.
Right. And then there are the technical challenges. We've got all these different blockchains that don't always play nicely together. Plus, these blockchains need to find a way to integrate with the legacy systems that banks and other institutions are currently using. It's a bit like trying to fit a square peg into a round hole.
And even when standards do emerge, it takes time for everyone to adopt them.
Absolutely. And then there's the issue of liquidity. Just because you tokenize an asset doesn't mean there will be a thriving market for it. Many tokenized assets are still illiquid. There might not be enough buyers and sellers to ensure you can easily trade them.
So you're saying liquidity risk is still very real in this market?
Definitely. And related to that, we have the challenge of price stability. You can have price discrepancies between the same token on different blockchains, and the price of a token might not always reflect the actual value of the underlying asset. There's also the potential for price manipulation and volatility that's driven by speculation rather than the asset's fundamentals.
So the price of a tokenized piece of real estate could fluctuate wildly, even though the actual building isn't changing in value.
Exactly. And then there's the whole security issue. We all know the crypto space has been plagued by scams and hacks. Robust security is essential for building trust in this market.
It's like the Wild West out there sometimes.
Yeah, kinda. And of course, regulatory clarity is crucial. There's still a lot of uncertainty about how security tokens, in particular, will be treated under existing financial regulations. This lack of clarity can make institutional investors hesitant to jump in.
It's like playing a game where you don't know all the rules.
Exactly. And then we have the oracle problem, which basically means ensuring that the data brought onto the blockchain from the real world is accurate and reliable. We rely on these third-party services called oracles to feed that data into smart contracts, but their reliability is a critical factor. If the oracle's data is wrong, the whole system can fall apart.
So it's like a chain reaction. If one link is weak, the whole thing breaks.
Right. And lastly, there are still some concerns about the stability and security of even the most well-established blockchains. The technology is still relatively young.
Yeah, it's not quite bulletproof yet.
Right. Now, with all of that said, let's look at a specific example. Real estate. We've got this white paper from Vertalo that really dives deep into this.
No, yeah, Crollo. They seem to be making big moves in the real estate tokenization space.
They are. Real estate is a massive asset class, but it's also notoriously inefficient. Vertalo wants to change that by leveraging blockchain technology. They're all about streamlining transactions, reducing costs, and opening up real estate investment to a wider audience.
So less paperwork, faster closings, lower fees.
Yep, that's the idea. They also talk about overcoming restrictions on foreign investment and enabling fractional ownership, which could be huge for smaller investors.
It's like making it possible for everyday people to own a piece of that luxury condo downtown or that beachfront property.
Exactly. Vertalo's platform is built to handle the creation, issuance, and management of these tokenized real estate assets. They also aim to offer direct trading capabilities and even explore lending opportunities backed by these tokens.
So buy, sell, and even borrow against your tokenized real estate, all through their platform.
That's the vision. And they're focused on making their platform easy to use for people who aren't necessarily tech savvy. They're also an SEC registered transfer agent, so they're committed to staying compliant with all the regulations.
That's a big deal in this space. It gives investors more peace of mind. What about existing real estate companies like REITs? How can tokenization benefit them?
Well, Vertalo sees a lot of potential for REITs to reduce their operational costs and reach a larger pool of investors through fractional ownership. They also think tokenization can make REIT shares, especially non-traded REITs, more liquid.
That's interesting, making these traditionally less liquid investments more accessible. What about the real estate crowdfunding space?
Vertalo sees a lot of opportunity there, too. Tokenization could provide access to cheaper capital for crowdfunding platforms and attract more diverse investors because of those lower minimum investments. Plus, it could create a secondary market for these investments, which would be great for both issuers and investors.
It sounds like they're trying to create a whole new ecosystem for real estate investing.
They are. Their core capabilities include things like ensuring regulatory compliance, maintaining a secure record of ownership, handling dividend payouts, and facilitating communication with investors. They're really trying to take care of all the behind-the-scenes complexities.
So they're like the backbone of this tokenized real estate market. Well, we've covered a ton of ground today.
We have. We've talked about the basics of RWA tokenization, explored its potential benefits and the challenges it faces, and even delved into a specific example with Vertalo.
It's clear that RWA tokenization has the potential to be a game changer, but it's still early days. There's a lot of work to be done in terms of overcoming legal and technical hurdles and achieving widespread adoption.
Absolutely. It's an exciting space to watch, but it's important to approach it with both enthusiasm and a healthy dose of skepticism.
Now, here's something for our listeners to ponder. As the digital and physical worlds continue to merge, how will technologies like blockchain and tokenization redefine what it means to own something? What impact will this have on different asset classes and the future of finance?
That's a great question to leave everyone with.
Thank you so much for joining us on this deep dive into RWA tokenization. We hope you found it informative and insightful.
Thanks for listening.